The ASX200 hits fresh record highs as all eyes turn to Fed Chair Jerome Powell's Jackson Hole speech, which could set the tone for global markets moving forward. Joining us today is Kyle Rodder from Capital.com in the studio. Good to see you, my friend. What's driving the ASX200 boom right now?
Well, it's a good question because I think that a lot of people have been talking about the current earnings season and some of the results that we've been getting. Obviously, that's naturally going to grab the headlines domestically, but I really think it's a global story at the moment. Effectively, what we've seen on Wall Street and across the globe over the last sort of 5 days is a little bit of a rotation out of these sort of tech growthy names on Wall Street in particular. So we've seen some weakness in the Nasdaq, but there has come some strength in some cyclical names, which the ASX200 has a very high weighting towards. You're talking banks and miners and things of that nature. So it would appear that we're sort of the beneficiary of that. We've obviously hit record highs, 9,000 points for the first time yesterday. Chinese stocks as well have hit a 10-month high in the last 24 hours as well. And if you look at the earnings season overall, in fact, I mean, there's probably been more misses than beats this week, or at least when it comes to those very sort of large cap names, CSL, James Hardie and things of that nature, have probably been a little bit more punished more the kind of misses that we've seen rather than investors rewarding companies that have beaten estimates. So I think this is basically a global story at the moment. A lot of that is underpinned, it has to be said, by a bit of a rotation caused by rate cut expectations in the States, and effectively that's sort of the lay of the land as we go into the the final day of the week. It really becomes, like you said before, this sort of Jackson Hole speech, whether this dynamic continues or whether there's a bit of a sort of wrench thrown in things.
Yeah, the tide's out at the moment until he starts to speak. But how are investors positioning ahead of Powell's speech? What's it all sort of feels like the night before Christmas for many of you?
Yeah, well, it can be. I mean, Jackson Hole Symposium, I suppose you could say, is maybe a bit of a Woodstock for central bankers, so to speak. But effectively, we've got markets starting to price in the risk that he comes out with something hawkish. I think that's why we've seen the weakness on Wall Street in the last couple of days, and you can see it in rates markets as well. Basically, start of the week, maybe call it 90%, slightly below 90% chance that we'll get a cut in September. It's down to about 70%, a little bit higher than that as of this morning. And the markets are really looking at some of the FOMC minutes, some of the recent data that's come out over the last week or so, and saying, actually, inflation could be sticky. Yes, the labour market is weakening, but is that enough of a justification, especially considering tariffs are only just starting to work their way through the economy and having an impact on inflation, to basically pivot and start to signal a level of dovishness? So the markets have not gone all in. Again, that's been tempered a little bit over the last couple of days, but certainly bet fairly significantly that we could see rate cuts fairly imminently. Even the possibility that we get a rate cut at every meeting from the Fed for the rest of the year, so that's 3 more 25 basis point cuts, that's being sort of ascribed as sort of a 1 in 3 chance. But if that doesn't happen, if the Fed's language effectively is the same as it's been for the last 3 or 4 months, which is let's wait and see what happens with tariffs and inflation, then that positioning that we have seen could be unwound fairly quickly, and that's when you start to talk about volatility in equity markets.
Okay, so let's talk about the expectations on US interest rates. More broadly speaking, take us through a bit about that.
Yeah, so effectively the markets have now sort of dialed back the expectations of a cut in September to about 70%. We did have some fairly solid data out of the States last night, which showed a bit of a pickup in services and manufacturing activity and some resilience potentially in forward-looking indicators of employment. The sticker there too was that demand has picked up, but a lot of survey respondents in these PMI surveys were talking about that they're starting to hit capacity constraints, which is to say that the demand is starting to pick up, the demand is there, but mostly because of tariffs and even perhaps a little bit of labour market rigidity as well. Yeah. That inflation prices are starting to pick up, and that's being passed through to consumers. So the concern is that you'd say, okay, well, there is the hopes that maybe there's a degree of resilience in the economy. Maybe the Fed doesn't have to cut interest rates quite as aggressively as previously thought. Again, this is just one data point amongst many that suggests that there is a deterioration happening in the labour market, but that's still happening in the backdrop either way of a economy that is struggling with inflation that is above target and maybe even moving away from target as well. So if that happens to be the case, and we do get that kind of language backed up by Powell over the weekend about this stickiness, you've got 70% chance of a cut pricing for September. Again, call it a coin toss for the next meeting, which is at the end of October or start of November. Yeah. December's a 1 in 3 chance for a cut as well. If again the focus remains on inflation, that comes out of the market. September maybe becomes a bit of a line ball, and like I said, that's when you start to see equities kind of pulling back from these record highs. Dollar starts to strengthen a little bit. Aussie dollar starts to weaken. All those sorts of things that kind of are typically symptomatic of a breakout in volatility.
So just on that, and if we do bring it home to Australia for a moment, how does productivity play into the long-term growth outlook, do you think, just to round out our discussion?
Yeah, well, I mean, it's huge. There's a sort of quote that I've shared before on the show here, which is from Paul Krugman, which is that in the short term, productivity isn't everything, but in the long run, it's almost everything. And so it's a critical mix of our long-term standard of living that the productivity crisis. And I think it is fairly fair to say that if it's not a crisis now, it will be eventually. Does get solved. And what does that mean for everyday Australians? Well, good productivity means that, again, standard of living picks up. The stuff that you have is more abundant and of better quality. And not only that, the kind of inflation that we've seen over the last few years, that's a downward pressure on inflation too, because the economy is producing more stuff. Right. So that's what we need effectively solved. And this is a long-term issue. It's not something that's really going to have a huge influence over the next few months or even perhaps years, arguably. But again, like I said, or as Krugman said, in the long run, really important, almost everything.
Kyle, well said by you, and thank you so much for joining me.
Thanks.